Welcome to the Stock Network's ASX Gems Investment Conference. At TSN, our mission is to connect investors with fresh stock education and deliver digital investor access that empowers smarter decisions. Today, you're about to hear from ASX-listed companies with leaders shaping the future of innovation, energy, technology, health and finance. Let's first start with Junbei Liu of TenCap sharing sharp market insight and disciplined investing strategies for the financial year ahead. This is your time to sit back, tune in and take notes because investing is about being informed, prepared and positioned. Welcome to the Stock Network's ASX Gems. Since the Trump tariff-induced falls in March, we've seen a remarkable rebound in equity markets in April that's caught many investors by surprise, especially given the weakening global economy and corporate earnings. To help make sense of this, I'm speaking with Junbei Liu, co-founder of TenCap Alpha Plus, a leading long-short equity fund. Junbei will help us to understand why stocks have bounced back despite challenging fundamentals, what role policy rate cuts have to play, and how investors can navigate this uncertain environment. Junbei, thank you for joining us on the Stock Network.
Well, thank you so much for having me. I'm very excited to be talking about stocks.
So am I. And if we look at the stock market, since April, equity markets have rebounded strongly, surprising many given the softer economic indicators and earnings reports. Can you outline what you think is behind this unexpected rally and also what sectors are leading the gains?
Yeah, absolutely. So look, it was quite simple. We first need to look at why it fell. It fell because the market couldn't digest or couldn't understand what the future tariff might look like. Donald Trump was coming up with very random numbers and every single day. So with all that kind of heightened level of uncertainty, many investors simply just said, you know what, it's too hard. Let me take my money off the table. And once there's clarity, I'll move back in. So essentially, that's why it fell. Now, from our perspective is that we sat there and thinking, okay, there are companies, clearly some companies get impacted because with the tariff and the others, but there are a whole lot of companies, that big bucket of companies that the earning doesn't get impacted and yet share price is 20-30% lower. So for us, it was a very clear buy signal into some of those sectors. The sectors like the technology businesses. So that doesn't really have the, selling the goods across the border and yet they are cheaper. Things like Promedicus, things like Technology One, things like 360, and the list goes on. These bucket of companies were, in fact, the strongest performers out of that. What do they call it? The Liberation Day. I always call it the Judgment Day. So they perform incredibly strong. That's just simply because, they shouldn't be lower to start with. Now, there's another bucket of companies where they actually focus, the growth is very much focused in Australia, Australian domestic companies. And these businesses, if China growth slows down, Australia economic growth slows down, then potentially get impacted. But that's a very long projection based on something we don't know what the outcome will be. So these sort of businesses, domestically focused businesses, were the second group of companies that we thought, okay, should continue to do well. Things like Wesfarmers or, your JB Hi-Fi all have performed very well since then picking up. And that bucket of company in particularly, though, the Australian domestic focused businesses, they are now increasingly look like have more tailwind to help them through over the next 6 to 12 months. With the interest rate already being cut twice, we got one more to come in July, and then potentially 3 more to come by the end of the year. That is very, very supportive for those businesses.
Absolutely. It's interesting you mentioned Promedicus because I remember last year a newspaper heading with your quote saying buy Promedicus on any weakness. So you were clearly ready to go when that weakness came.
Oh, absolutely. Look, at times it does feel it's terrifying. That's what, sometimes share market when it's in free fall, which is very rare. You don't see that very often. Last time we had free fall like this was probably COVID periods where we have this sharp fall because we don't know what was going to happen. It's very rare. But when it does happen, it's almost just by the quality companies, almost by the quality companies and forget about it for the next few months because volatility eventually will pass. Then it comes back down to the quality of the company, its asset, its business model, or its product.
Excellent. Now, you did mention, of course, that policy is looking favourable to some more interest rate cuts. How do you think this is shaping the investment strategies for yourselves? And also, can you share some examples of stocks that have had a strong performance for you?
Yeah, absolutely. So if we're talking about, so putting the tech aside, they are done very well. But if you look at the domestic cyclicals, we actually think that there's still a lot of opportunity in this space, simply because at the moment, economic conditions still a little bit patchy here in Australia. We had a couple of retailers had a bit of downgrade because of price competition, but we know things are getting better. We know with the rate cuts, economic activity will bottom in the next few months. So, your August reporting season will be the bottom of your cyclical company. So, it is to come. And remember, share price will always try to track what's going to happen in 12 months, not what's going to happen in the next month. So, so you need to stay ahead of it and buy those businesses. Some of the businesses that has lagged that still represent great buying opportunity, things like REA Group, with the housing clearance rate where it is at the moment, and house prices on the way up, the listing, it's just a matter of time before it moves higher. And the company just put through another high single-digit price increase through, will guarantee good earnings growth in the next 12 months. We think that one will do well. Company like Seek, job boards, how connected or how linked can it be to our economic activity with rate cut. We think this company is probably trading at the bottom of its cycle. And there's many other more. Look, if we look at the retailers, I know JB Hi-Fi has done very, very well, but I think the earnings will continue to do quite well. But what's interesting is look at some of the home retailers, housing retailers. So, some of them actually had been sold off because of patchy retail condition. I think they're worth a look because they're much, much cheaper than the likes of JB Hi-Fi. And I think in the next 6 months, when the headwind turn into tailwind, these businesses all do pretty well. Things like Harvey Norman. Recently, we had Adair just had a downgrade. Potentially, that's looking interesting. So there's a lot of opportunity in that space. But look, as investors, you need to do your homework.
Absolutely. And thank you so much for taking us through all of that, Junbei, as the end of the financial year approaches. Great to see the blue sky ahead, and really appreciate your time and insights from TenCap.
Thank you so much for having me. Always a pleasure to talk about the stocks. We love stocks. It's like treasure hunting, especially end of financial year. You get the end of financial year sale in the shops, and you get end of financial year sale in the share market too. So you need to stay nimble and find the opportunities.
Well said. Thank you.
Thank you very much.
TIP is an ASX listed investment house focused on compounding knowledge and wealth. We believe that everything starts with education and research, which leads to direct, actionable insights that can be put into practical applications, and then, through those applications, result in iterative improvements to deliver higher profits, valuable ideas, and better returns. We operate 3 verticals, each of which uses proprietary research-driven insights to create better investors and better business people. Our first vertical is education and advice, where we advise others, providing investment banking, consulting, and advisory services to high net wealth and institutional clients. In that division, we have approximately $1.6 billion under advice, and we have delivered our clients an 18.39% per annum gross return for 24 years. Our second vertical is funds management, where we deploy others' capital using the insights we are generating. We provide direct-to-consumer wholesale and institutional capital in listed and unlisted funds management in active equities, with approximately $250 million of funds under management and an average outperformance of 300 basis points per annum for over 10 years. And then finally, we deploy our own balance sheet into the same things, providing strategic investments in minority and majority stakes in private and public equities, with approximately $130 million of total assets on our balance sheet and an average money on invested capital of 2.9 times. This has meant that since our IPO, we have grown our EBITDA, or our earnings, by 119% at an average of 17% per annum, with our total assets now at around $130 million and net assets of $86 million. However, our share price has diverged, as unfortunately I think has been the case for many companies outside the index. And so TIP is now trading at an 81% discount to our IPO multiple, a 75% discount to the ASX Small Ords, and a 47% discount to our net assets. So if you believe, like us, that the goal is to find great businesses run by talented management that are available at a material discount to their intrinsic value, well, maybe TIP is one for you. Thank you very much.
My name is Ganachir Zundisuren, Managing Director of Asian Battery Metals, Mongolia-focused critical mineral explorer. So we are emerging a copper explorer and potentially a developer in the future. So I would like to introduce about our company and why it is a good value for investment. First of all, it's Mongolia. It is located right next to China, which is the largest producer of the EV and EV materials that's used in batteries and also in EVs. So its location is unbeatable for economic and logistical competitiveness. It is also quite underexplored, which provides upper hand for exploration companies like Asian Battery Metals, with its robust regulatory environment that's continue to support foreign investment in the country. And on top of that, our company has a number of projects in Mongolia. Our flagship project is OncoSil copper nickel PG project in southwest part of Mongolia. It is a brand new discovery that we made in 2024 for magmatic mafic intrusion related copper nickel sulfide. Country itself vastly improved over the last 15 years in logistical infrastructure and also in regulatory framework. There are a number of multiple companies operating from ASX and TSX listed companies in the country over the last few years. One of the examples are Oyu Tolgoi, which is probably the largest copper mining operation that came online over the last 10-15 years globally. As you can see, these are the new mines that opened in the country over the last 15 years, showing the robust legal framework and showing that Mongolia itself is a mature mine jurisdiction. As you can see from here, globally, China supplies 50% of the pure metal in pure metal form of the copper, but they produce only 9%. That actually shows there's a substantial demand for copper concentrate from China in the future. And there's a number of different studies suggest there's a great demand future for copper in the future, quite in sustainable form. The company itself, I just mentioned. On top of that, we have a very proven team. So our team consists from Mongolian geologists and Mongolian business people who understands how to operate in the country and were part of the successful exploration and development team in the past. The latest update, the OncoSil discovery. It is a one-of-a-kind discovery that we made last year. It's a high-grade mineralization confirmed in shallow depth and starts from the surface, indicating it is amenable for potentially future open pit operation. Lateral and depth extension is supported by latest drilling. And then we have intercepted massive sulfide mineralization in different zones of OncoSil. On top of that, key thing is really emerging regional potential with number of different targets emerging based on our geological and geophysical exploration. And we have raised capital in last February, so we are fully funded for 2025 to execute our strategy to evaluate and to show the large real potential of the OncoSil project to the market. Number of the intercepts, we have as I mentioned, we have continued to intersect massive sulfide, including and high-grade zones in our drill holes. One of the key, as you can see, we have quite a core of quite high-grade massive sulfide, usually more than 3 to 4% copper and more than 3% nickel, and plus PG 1 gram, more than 1 gram per ton PGE plus gold. And that's an incredible intercept for massive sulfide. But more importantly, massive sulfides are actually, massive sulfide itself is enveloped, surrounded by the net textured and high grade, heavy disseminated mineralization. As you can see here, usually we have 4 or 5 times larger higher grade mineralization in disseminated and net textured than massive sulfide. It is indicating there's a good tonnage potential for future potentially a mining operation. Most of the intercepts are quite shallow. Some of them start from the surface, high grade. Some of them lies in 100 meters below surface. Regional targets, as I mentioned, MS1. We have just discovered new ultramafic intrusion with weak sulfide intersected in the drill hole. But more importantly, this is a concealed geophysical target, and that also same for the MS2. We have intersected right rock, so that actually expands our footprint of the ultramafic for future exploration almost for 5-folds. So it is a very exciting times for us in regional exploration in next few months. Very critical 3 months is coming for us. The assays from our phase 2 drilling are still pending, and then we are doing a first time a ground EM on this property. So for this type of mineralization, ground EM is a primary tool to identify those drill targets. We are hoping that the ground EM that's being completed by Gap Geophysics are going to provide us additional targets in our next round of drilling, which will commence right after the EM study finished. And then on top of that, our preliminary or initial metallurgical study will be back to us in July, and we will initiate our drilling close to end of the July and early August again. Why AZ9? It is in early stages of the discovery. So we're going to go on a great journey to show that this discovery is potentially economically or commercially important project in the future. And to deliver that, we will do our exploration. At this stage, it contains high-grade zones in the system, and the system itself is growing in all directions, depth, lateral, and also in regional sense. Then, strong convergence of the geophysics and correlation with the geology, indicating we have efficient tool, and we are well funded and extremely fast moving. Exploration is completed by us since our listing last June, and the projects are quite accessible, close to market, close to Chinese-Mongolian border, and in low-cost operating jurisdiction. Company snapshot. We have quite experienced board and experienced team operating in Mongolia. We are all together. We are quite comfortable to promote Mongolia as an investment destination and deliver on our strategic plan with efficient exploration.
Hello, I'm Mark Pivac, CEO at FBR. FBR is all about automating the construction industry, an industry which has been around for thousands of years, with the aim of addressing the global housing crisis, and in particular the housing crisis in Australia. Here's our ASX normal disclaimer, which I'm sure you're all familiar with. So I've recently become CEO. I've been involved as Chief Technical Officer for FBR since its founding. I'm the chief inventor of most of FBR's technology. and I've recently taken over as CEO, and my mandate is to clarify the business, sort out the capital requirements of FBR, and engage with investors by keeping our current investors, engaging with past investors, and introducing new investors to the FBR story. So in terms of clarifying the business, FBR is all about our Hadrian and its systems of production and sales. We currently have a Hadrian machine in the USA, in Florida, which has recently completed a 10-house demonstration program over there. And we're currently in the process of building a pipeline of work for that so that we can then send a team over there and get US operators trained up to enter the wall as a service market in the US. We're also developing a similar pipeline here in Australia, and we're also establishing a machine sales capability as well. And to that end, we've recently signed an MOU with Habitat Builders up in the NT to sell a Hadrian machine up to that booming construction market up there for $7.8 million. We've currently got a lot of discussions happening around the globe, but particularly in Perth and also in Florida. And we're also looking for adjacent applications of DST and the long boom technology, because what our core technology enables is the accurate positioning and placement of objects and doing work at very large scales with robots that are much bigger than has been traditionally used in the factory environment. And to that end, we've just signed an engineering services agreement with Samsung Heavy Industries with the aim of developing an automated shipbuilding solution. We've recently restructured FBR more in line with the capital available to it. And with that, we've reduced our annual burn from about 36 million a year to 12 million a year. We've cut down our workforce, unfortunately, but we have managed to maintain key capabilities in that, which will enable FBR to move forward. And we've also maintained our portfolio of 400 IP rights across 41 different patent families in many different jurisdictions around the world. And my aim is to start monetizing that significant IP portfolio. On the investor front, I've just recently completed a roadshow in both Sydney and Melbourne. And prior to that, I've been to Melbourne, Sydney, and Brisbane quite recently. And that'll be an ongoing thing as we spread the word about FBR. We've introduced our Investor Hub platform to enhance communication with shareholders, and we see some pretty good positive communications happening there. And we've got an ongoing process to improve our engagement with the equity markets. Samsung Heavy Industries is one of the leading shipbuilders in the world. I've visited their Gyeonggi plant up in Korea, and Samsung Industries actually approached us about 18 months ago with an interest in our dynamic stabilization technology and our long boom technology as well, with the interest of automating the shipbuilding process. So they already have a lot of automation in their shipyards, and the processes that we're looking at automating for them, they've looked at in the past and haven't been able to automate, but they see that DST will really provide a way to do that, and we're working through that process. And this first phase of work is to prove out some key concepts, which are very important for that automation, and that should clear the path to the broader automation project, which will see it ultimately arrive in ships and then into shipyards across the world. This slide covers our machine supply agreement with Habitat Builders up in the NT. So FBR will be supplying the machine along with operating and maintenance training and remote IT and operator support and so on. And of course, the licensed access to the ancillary software that they need, including the architectural designer, which is the software which we've developed, which takes a house plan and works out where all the bricks go in that building and ultimately ends up controlling the Hadrian machine. So Habitat's a Darwin-based construction and development company. They specialise in retail, industrial and commercial construction. They've got a really solid pipeline over the next 3 years, and that's for both residential, commercial and defence projects. So that initial purchase order should be coming through for $7.8 million, which will be quite revenue positive for FBR. We already have some Hadrian machines in stock. We have one now which is physically complete. This is H4. and we're in the process of commissioning that. So we're looking forward to delivering machines to Habitat in the very near term. Hadrian X is a mobile construction solution. The boom folds into the Hadrian machine and can reach out up to 32 metres, which is big enough to build a typical house that's constructed here in, for example, Western Australia or Florida. Typical houses being, 4x2, 4-bedroom, 2-bathroom houses. We can build up to 3 stories high. We can actually go up to 4 stories high, but the available work envelope is fairly small at 4 houses. So we suggest that, normal applications would be 3 stories high. And the way it works is with that long boom being extended, the boom actually can bounce around or be blown by the wind. So the boom by itself is not particularly accurate, but we track that with a laser tracker, and then we correct in real time the final position of the bricks or blocks with a very highly dynamic robot at the end of the boom. And of course, Hadrian does all the other things which may be needed, such as cutting blocks and applying adhesive to those blocks. In the US, there's a massive opportunity there. The market there is absolutely huge. There's about 1.5 million houses a year built in the US. And yes, it's true that a lot of different construction methods are used over there, and in particular, timber building and stud framed building. But in the southern states, such as Texas and Florida, Louisiana, Georgia, Alabama, and so on, those states are predominantly a masonry market now, particularly with the more extreme weather events which have been occurring over there. So we're very, very keen to get into that market. And that's why we've done a demonstration program in the US. Here are some of the homes which we built in Florida. We did 10 in all. They're typical residences around the Fort Myers area, which is a strong growth area. And here's a slide with our contact details if you would like to find out more information. And I'll quickly run through some appendices here where we have a little more detailed information on FBR and Hadrian X. This slide covers why we would use Hadrian X, which is the most advanced end-to-end autonomous robotic construction solution that's available. Has efficient mobilisation and demobilisation so that we get really good utilisation of the building time on site. Our main tenets are speed, accuracy, safety, and waste reduction. And when you deliver those 4 things to a builder, you get a cost saving. And our automation solution means that we can actually build a house in a day, which is quite a fantastic speed improvement for builders. And of course, they can cut their costs quite significantly. We think that Hadrian X will address a key component of the global construction labour shortage. Brick and block laying is an arduous task. It's a very skilled task, and it's very difficult to attract new people to do that trade, even though it's well paid. Moving forwards, the construction industry really needs automation solutions, and Hadrian X and DST can provide those. There's a lot of reasons to automate construction. The brick and block laying process hasn't changed much over the last 6,000 years. But with the introduction of Hadrian X, it enables the digitalisation of that and attraction of a new workforce. And of course, there's significant labour and cost savings involved with Hadrian X. We have 2 main business models. The first is wall as a service, where a builder can engage with FBR or a joint venture directly and order basically contract bricklaying services. And of course, our other business model is to sell Hadrians to builders or bricklaying contractors who have enough work to justify owning a Hadrian X. We have a lot of good sustainability points. We use very good materials which are low embodied energy. We can work with a variety of different local building materials to minimise transport costs. We can work with quite a wide range of bricks and blocks. And of course, because Hadrian is on site for not very long, there's a lot less travel to and from the construction site by workers and so on. These are some of the UN Sustainable Development Goals, and we can contribute quite significantly to those. As I mentioned previously, we're also looking at adjacent opportunities for FBR's significant IP portfolio, and the benefits of robotics and automation, such as speed, efficiency, cost, and waste reduction, are increasingly making it an attractive area of investment for industries. And recognition of FBR's expertise in this area has generated potential opportunities to utilise our existing know-how to develop custom solutions for multi-billion-dollar organisations around the globe. And as we've seen, Samsung Industries has moved into a engineering services agreement with FBR. We've got discussions underway with parties operating in the steel and mining and also the shipbuilding and construction industries to scope out robotic solutions using FBR technology and also our significant R&D capability. Our IP portfolio provides us with a competitive advantage and makes it a really good choice for potential users of technology and adjacent use cases. So that now ends my presentation. Thank you very much.
Hello, I'm Dr. Mike Jones. I'm the Managing Director of Tenant Minerals Limited. And this picture here is of what we call our magic lake. It's Lake Hope. And we believe it's magic because in the top 2 meters of that lake there is something in the order of $15 billion worth of a niche mineral, but widely needed in the energy transition and in the high-tech industries. And that mineral is high purity alumina. And our plan is very straightforward. We're going to dig up that lake, the top 2 meters. We're going to transport it to Perth, where we have recently acquired a 50% share in a pilot plant, and we're going to produce the high purity alumina from that, which will get turned eventually into this. And this, if you don't know, is the Las Vegas Dome, and it is one of the world's great entertainment centers. And that dome is covered by 1.8 million light-emitting diodes. And behind every LED that goes into every light that's going in globally now, and every LED that you see around the place has a thin piece of sapphire, which is a form of high-purity alumina behind it. And as you can imagine, that market is growing quite tremendously. And we believe that between our lake and the process that we've just acquired, we have the ability to transform the production of high purity alumina going forward. As well as LEDs, it's used extensively in the manufacture of semiconductors, and it's also thermally inert and chemically inert, and it's used to help dampen down the heat that's generated from all of these new AI data centers that are being put up globally. It's also used in lithium-ion batteries and other battery architecture to prevent thermal runaway. We've all seen pictures of the Tesla batteries catching on fire. The separators, if they're coated in HPA, prevent that from happening. As a result of all that, we're seeing demand for HPA grow at an annual rate of about 20% per annum, which is very significant. And there's probably going to be a tightening of supply in the next couple of years. And that's about the time we hope to get into at least small-scale production. And we're going to see the market double by 2030. High purity alumina is actually a very valuable product. We're seeing here prices per tonne in the region of sort of $15,000 to $30,000 per tonne in what we call 4N. That's 99.99% pure alumina. And it's a high margin, high demand business. You can command much larger prices for 5N and 6N. These are smaller volumes, and so we're really going to tackle that 4N market in the first instance. This is how we found $15 billion worth of HPA with a rubber mallet and a push tube. We drilled out the entire resource, which is enough for at least 40 years of mine life for 150,000 Australian dollars. This is what it comes out looking like. It's incredibly fine grained. It's mostly naturally nanometer in scale. Doesn't need any on-site beneficiation, no crushing or grinding, etc. And so the plan is very straightforward: dig it up and transport it to Perth. This is the location, and as I mentioned, 500 kilometres east of Perth. And the intention is to bring it into Perth, probably into Kwinana, where we'll build the first large plant. We've just recently completed our PFS, our pre-feasibility study. It showed a fantastic NPV of $1.1 billion at a very conservative discount rate. But the important figure here is our operating cost. This is a cost curve analysis, jumped into the future a little bit, where we're imagining the impact as a share of the marketplace. And we believe that at this stage, we will be one of, if not the lowest cost producers of HPA anywhere in the world because of the nature of our material and the nature of our process. We have a very important byproduct credit of SOP, sulphate of potash, and we believe that we can sell that readily into the West Australian marketplace. So overall, it is a world-class set of economics. Going forward, we have recently received a federal government grant of $2.9 million to work with Edith Cowan University and CPC Engineering to build a plant based around membrane technology. Now, membranes are used extensively in the water treatment industry. We're bringing them into the mining sector along with ECU, and we believe that it can be inserted in many places in our process flow sheet to improve recoveries, to improve the quality of the effluents that come out of the back end, and to improve our reagent recirculation. And so all in all, that should lead to a further drop in operating costs as we complete the definitive feasibility study. So we've recently acquired the assets of one of our competitors, went into administration for financial mismanagement. We've acquired a fully functional high purity laboratory. There's only 2 of these in Western Australia. We now own one of those. We've also, as I mentioned, acquired a 50% share in the pilot plant, which is basically going to be turned on this week. And we will be in small scale HPA production within a very short period of time. The biggest thing that we purchased, though, is actually time. Until we had this acquisition, we were still in the test work mode, even though we were doing pre-feasibility studies. And what we've been able to do is basically jump 2 years ahead, save at least $6 million in overheads. And we're now actually the only other company on the ASX capable of producing anything like any quantities of HPA, apart from the leader in the space, which is Alpha HPA. And if you haven't followed that story, it is a great Australian success story. We believe now that we can, once with the pilot plants up and running, we can export the technology in a modular fashion around the world and scale up to many thousands of tonnes per annum production at a relatively modest capex of in the tens of millions for each of the modest scale plants that we're going to build. It's a huge breakthrough for us, fantastic acquisition, and bolting that together with our Lake Hope project will deliver something very special. So look, going forward from 2025, the pilot plant is being switched on, as I mentioned. It's going to take us sort of 6 months or so to get it up to scratch. And then that's going to allow us then to enter into the HPA market, start engaging with customers into 2026, looking for offtake, and then obviously increasing our speed into the marketplace. And then looking to scale up into North America sometime in 2027. And that's going to be a fantastic step for us. Impact Minerals, as I said, code IPT. We've got about $2.5 million in the bank, 24 million market cap. So there's definitely some interest in what we're doing. And we've got very strong support from 2 major German shareholders going forward. And so this is a fantastic time to have us on the watch list. I'll just finish by talking about Alpha. 8 years ago, they were like Impact Minerals, $20 million market cap, came across a new method to produce HPA, and they've been on a journey since to $1 billion market cap. It's taken them about 8 years. We believe that we'll be able to get to the same position of production as them in 4 years, and we're 2 years into that journey. So you can look for some acceleration in the next couple of years. One of the big things about Alpha, they've just announced that they're building a 10,000 tonne per annum plant, which is where we aspire to get to, but they've had indicative demand for at least 30,000 tonnes of product. And so we have no doubt as we build our plants around the world that the customers will come. And so look, finish by saying, look, come with us on the journey. We aim to be one of, if not the lowest cost producer of HPA globally. We've got a unique deposit in Western Australia, the best place to work in the mining industry, an industry disruptive metallurgical process, and we're rapidly building out our capabilities in that final product specification ready for offtake. As I mentioned, a bit of a supply deficit in 2027, and we're looking to deliver at least modest product into that at about that time. So thank you very much for listening, and if you have any questions, please get in touch with me.
Well, thank you for having me. Just an overview of AML 3D. So AML is a combination of welding, metallurgical science, robotics, and software. And we combine all 4 of those aspects into a system which we called the Alchemy system. That's our proprietary 3D metal printing system. It's actually one of the largest open-air turnkey 3D metal printing systems in the world. We have patented technology, and those patents are registered in Australia, New Zealand, Japan, and right throughout Europe. And we're in the process of registering it in the US. In terms of the capability of our technology, we print large industrial parts for defence, oil and gas and aerospace, and these tend to be industrial parts for operating use. It's a fairly large, complex parts. In terms of our technology, it can be deployed anywhere in the world, so you can deploy it in the field at the closest to the point of need where you need those parts manufactured. So AMLs are scaling up rapidly in our demand, and recently, back in February 2023, we entered the US defence market. In April 24, we decided to enter the US by setting up a US technology centre, and then in November 24, we raised 30 million from the ASX, from the stock market, through institutional investors, with an allocation of around 12 million for the US. And that is envisaged to be doubling the expansion of the US facility that we've set up in Ohio. So in June 2025, we officially opened the operating facility of our technology centre in Ohio, in Stowe. Over the last few years, AML has signed up close to 19 million in orders, and that's particularly with the US Department of Defence, US Navy. And according to Austrade, we're one of the largest exporters under AUKUS, which we're quite proud of. Our growth has been underpinned by a manufacturing license agreement with Blue Forge, and that allows us to have access to designs for nuclear attack submarines to be able to print and manufacture parts. We're looking forward to taking a share of the $951 million allocation, which has been given to Blue Forge, some of which has been allocated in for advanced manufacturing and the progression of. In terms of tripling our access to market, under the marine industrial base exists the submarine industrial base, which is our key customer at the moment. And that's been added to by adding surface fleets and munitions under the submarine industrial base. So we've effectively tripled our access to market. We've just been back from the US after a trip for the last few weeks, and while we were over there, we went and met with the PO for Land Systems, TACOM, and also for NavAir. These are sort of new areas that we're looking to grow into outside the submarine industrial base to round out our defence capability. In terms of NavAir, we're really impressed with the progression that NavAir have made with additive, and in particular with powder bed fusion technology, and they're looking to go into other forms of technology. What we're hoping for is their budgets to be expanded when NavAir falls under the marine industrial base next year in 2026. We also met with the Program Executive Office for Land Systems, that's at the US Marine Corps, and we're really impressed at the progress that they've made using additive as well. We're in the middle of just identifying parts that we could manufacture for their land vehicles using WAM. So it's actually quite an exciting process to be involved with. And they've also asked for a containerized system concept to be developed so we can deploy our technology into the field. In terms of strong engagement from government officials, we met with Senator Bernie Moreno, who's very good and close friends with the Undersecretary of Defence of Policy, Elbridge Colby. We also met with the Senate Armed Services Committee and the House Armed Services Committee. All are very supportive of AML and the work that we're doing. And then finally, we had Representative Amelia Sykes from Ohio, representing the manufacturing caucus for a site tour of the new facility. What we learned was that there are delays in the budget with the continuous resolution being held up by the Secretary of Defence. But what we did learn is that that should be unlocked fairly soon after the Congressional Spending Bill, aka the Big Beautiful Bill, is approved. Then there should be some funds that will flow post that bill being supported. Congressional representatives are also very supportive of the AM efforts, and what we could see in the budgeting process is that there are certain line items against high priority programs which have been allocated to AM, which is really promoting the fact that AM is taking hold. And then finally, promoting AM in the use of the 2026 NDAA is really important as well. So leveraging the advantage of our technology. So we're advocating now moving forward for the defence policy and appropriations around the NDAA language, and that we can continue to expand that language on how additive is included in the NDAA. Secondly, there's access to the shipbuilding. So we've seen make shipbuilding great again. We want to be at the forefront of the advantages of taking advantage of that as that sort of rolls itself out through the US. And in particular, with our experience in the defence marine environment, we could see that we could translate that into the commercial environment as well. Leveraging our US Technology Centre for the grand opening, we're really pleased to see that we had over 50 people in the session for the grand opening of our facility. And we're leveraging opportunities in the MIB across all three areas to take hold of our additive technology as a part of that. And then finally, expanding into other opportunities. We'll continue to grow our network into the Navy and across the DoD. We're pursuing growth in nuclear in the Department of Energy. We're leveraging MIB activities and access to the UK MOD. And we've just had a delegation from AML's executive team come back from the UK and from the MOD. We're expecting some work to flow from that. And then finally, supporting the AUKUS investments in Australia and elsewhere. I won't go through this, but this just highlights the stakeholder engagement, advocacy, and the communication strategy that the company has across not only the NDAA, but Appropriations Committee, and also the approval of budgets such as the CR. On that note, I'll conclude. Thank you very much for your time.
Welcome to this investor presentation on OncoSil Medical. I'm Nigel Lunga. I am the CEO and Managing Director of the company. Appreciate you being here and listening to this presentation. So what is OncoSil all about? OncoSil has a device that delivers targeted radiotherapy for pancreatic cancer. The OncoSil device is now quickly penetrating its addressable markets. So we are now in the process of commercializing the OncoSil device as an active implantable brachytherapy delivering targeted radiation of phosphorus-32 to pancreatic tumors. We're available for sale now in over 34 countries via the CE mark. Our commercial ramp-up is expected in fiscal year 2026 and beyond. We are now in the process of increasing market access via label expansion, combining a new method of delivery, and adding the addition of a more commonly used chemotherapy known as FOLFIRINOX. So right now, we have the ability to accelerate market penetration with a much shorter sales cycle and an increase in the addressable hospital sites within the EU and the UK. We believe we've also got a platform technology that can be leveraged into other cancers with solid tumors such as bile duct cancer, liver cancer, and potentially also glioblastoma. So what are the key commercialization metrics? So we have an indicative US dollar sales price of approximately $24,000 per device. The gross margin currently rests at 50%, but once we are able to supply from our own manufacturing facility, that will certainly increase to 65% in calendar year 2026, with our target of greater than 75% expected at scale. So there are cost out initiatives driving lower fixed cost base. It's an overall 20% reduction in OPEX costs. And we have a negligible requirement for additional CapEx in the near term. We're certainly well capitalized after a recently completed successful equity raise. One of the important things to consider here is that pancreatic cancer prognosis really has remained unchanged for about 40 years. And as you can see from this slide, there have been significant improvements to the likes of prostate, breast, bowel cancer, lung cancer, And if you look at the bottom of this slide, you can see that pancreatic cancer has had very little movement in the past nearly 4 decades. So what does all that mean? It means that survival rates for patients with pancreatic cancer is very poor indeed. Median overall survival of about 8.5 months. Less than 12% of these patients actually reach 5-year survival. So it has a lower survival rate than any other cancer. The number of cancer cases and deaths both are estimated to increase by 40% before 2035. So what does all that mean? It means that we urgently need new therapeutic options. So what does the OncoSil device look like, and what does it actually do? So the OncoSil device has the ability to increase resection rates, and resection, as we know, in any cancer, if you can have it surgically removed, that's still considered the gold standard. We have the ability to downstage an increasing number of patients to resection. We also have the ability to improve overall survival benefits and certainly enhance patient quality of life. So the device is intended for the treatment of locally advanced pancreatic cancer. It is delivered via endoscopic ultrasound guidance with a direct intratumoral injection. It is a single-use product, so it's used to treat one patient only. 98% of all the radiation, which is P32, as I mentioned earlier, or phosphorus 32, is delivered within 81 days of the injection, killing malignant cancer cells with no damage to surrounding tissue, because we're delivering this from an internal perspective. It's not like an external beam radiation machine that may have to go through surrounding organs and can create concurrent damage to organs. So we're delivering radiation from the inside. So this requires only one supervised procedure, given the simplicity and familiarity with standard everyday biopsy procedures. So with that, we are also now happy to inform you that we've completed a study which was known as the PancaSil study, and that is a study that allowed us to deliver the treatment percutaneously. We believe that this is going to significantly change the way we address the market and accelerate market penetration. So the study recruitment was completed this month. The top line readout will be in Q3 of 2025, and we're targeting Q4 calendar year 2025 to make this commercially available to interventional radiology. What are the recent achievements of the company? So again, mention of the PancaSil trial. This is a landmark trial for novel percutaneous delivery with intent to drive market access and adoption. That was completed earlier this month. We are now one patient away from completing the TRIP FFX study, and TRIP is a study that will serve to add FOLFIRINOX to the label. We have current engagement with US FDA on distal cholangiocarcinoma. And as some of you may be aware, the German Federal Joint Committee, or GBA as they're known, has approved a fully funded coverage with evidence development phase 3 trial. We've also engaged in a second manufacturing facility in Sydney, Australia. That fit out is complete and just undergoing current validation. So we've also received UKCA certificate from BSI in conjunction to MDR approval received from BSI for the EU. We've also got 120 German hospitals that have successfully applied for NUB status, and what this enables the hospitals to do is to negotiate it gives them the ability to negotiate reimbursement from the statutory health funds within Germany itself. So what are the upcoming milestones? So significant commercial catalysts over the next 18 months are TGA submission, expanding into new hospitals and existing geographies. That is in the certainly in the first half of that occurred in the first half of 2025. In the second half of 2025, we've seen the completion of the PANCASIL study. We will seek to provide expanded label approval to include percutaneous delivery, and then, of course, also the completion of the TRIP FFX study, which is rather imminent, as I mentioned earlier. The TGA anticipated approval. We have an IDE filing with FDA for locally advanced pancreatic cancer sometime toward the latter half of this year. And we anticipate also having the first commercial supply from the Sydney, Australia facility. And we also look forward to perhaps the finalization of the clinical trial design that is sponsored by the GBA. That said, heading into 2026, we will see label expansion with the addition of FOLFIRINOX chemotherapy. That's simply because we have to follow the last patient in the trial for 7 months. So that is going to occur in the first half of calendar year 2026. We also look forward to the commencement of the GBA study in the latter half of the first half of calendar year 2026, and we will also seek to launch in GCC markets, as well as have filings in Argentina, Brazil, and South Korea. In the second half of 2026, we will see launch of the OncoSil technology in Southeast Asian countries, and we are hopeful that we will see an FDA approval for distal cholangiocarcinoma. So continued focus on the commercial model. We've got a compelling cost-benefit proposition with no direct competition. There are attractive unit economics, as I mentioned before, about 24,000 US, which translates somewhere into 22,000 euros. And we are targeting a gross margin of greater than 75% once we are at scale with the new production facility. There is no direct competition. We've been granted breakthrough designation status in the United States, European Union, and the United Kingdom. We are the only commercially available or in development targeted radiotherapy for locally advanced pancreatic cancer. It's really a capital-light operating model. There's a concentrated industry structure with high volumes undertaken at centers of excellence. So we have a high return on capital with relatively small sales force requirements. And there is commercial scale manufacturing capability with end-to-end manufacturing capabilities and logistics already in place, and that enables us to meet commercial quantities. So there are multiple high-value initiatives to broaden market access and accelerate commercialization. So again, that is the additional of the ability to administer the treatment percutaneously as a result of the recently completed PANCASIL study. And there's the label expansion of additional chemotherapy, that being the TRIP study, and enabling us to add FOLFIRINOX to the label, and our ability to expand now into new markets such as Argentina, Brazil, Chile, France, Southeast Asia, South Korea, and Switzerland. And I thank you very much.
So thanks for the opportunity to present at the Stock Network's ASX Gems Conference. My name is Andrew Shute. I'm the Chief Corporate Development Officer at EBR Systems. So my goal today is to share with you why we believe EBR is an undervalued investment opportunity, but with the foundations in place to be a high-growth medical device company. And this is probably best explained by reviewing a summary of our investment thesis. So EBR has developed a novel medical device, the world's only leadless pacemaker to treat heart failure. Now, while we participate in the cardiac rhythm management market, and that's a market that's dominated by three major players, Medtronic, Abbott, and Boston Scientific, we are not in direct competition with them. In fact, we believe we're complementary. We are focused on treating patients who fail to benefit from traditional lead-based therapy. Now, there are other leadless pacemakers in the market, but these are indicated for treating patients with bradycardia or slow heart rate. So at launch, we expect to have a large addressable market. In the US, this will be $3.6 billion. And we expect this to increase as we look to expand into other markets, including Australia, and expand our indications. Now, our pathway to market was really underpinned by the FDA's breakthrough device designation. And this allowed us to have a direct, informal communication channel with the FDA during the review process. And this actually gave us the confidence to go to the market and predict the date of FDA approval. And in fact, we received this a couple of days earlier than anticipated. And the other benefit of the breakthrough device designation is it allows us to qualify for two reimbursement schemes. The first of this is NTAP, or the New Technology Add-on Payment, and this is aimed at inpatients. And the second is the TPT, or Transitory Pass-Through Payment, which is aimed at outpatients. And both of these are expected to commence in October of this year. And I think it's actually a testament to the clinical need or demand for WISE that we've already received the first implants of WISE ahead of receiving these top-up payments. Looking towards commercialization, we plan to have a disciplined approach. So during our first year of commercialization, will actually be considered a limited market release. So instead of going out in a scattergun type approach, we're going to have a very, very focused target list of sites that we'll be penetrating. And these will be a combination of sites that participated in our SOLVE CRT study, and they'll be supplemented by some additional strategically important sites. The benefit of this for us is allow us to build KOL advocacy, allow us to showcase patient success stories, and build those internal referral pathways within hospitals. So our initial focus here will be on building a sustainable utilization rate. We'll initially be targeting 2 implants per site per month. And once we start to achieve that on a site-by-site basis, we'll move on to start to penetrate our phase 2 sites. And these are really high-volume sites where we already have strong engagement from our future implanters. And then we'll move into our full commercialization phase. And to achieve this, we'll be utilizing a direct sales force. We have already put in place a strong leadership team led by Eric Strandberg, our Chief Commercial Officer. He's recruited 2 area sales VPs, Mike Manassi, who will be responsible for the East Coast, Josh Illiker, the West Coast. And in turn, they've both recruited a stellar field team. And at launch, we'll expect to start with 7 or 8 sales teams. And each sales team will consist of a sales rep or a clinical or technical specialist. Now, in January, we announced we'd signed an 11-year lease on a new facility, just a mile or 2 from our existing building, and on great commercial terms, including $4 million worth of landlord finance tenant improvements. And this site has a footprint just over 3 times larger than our current facility. Now, while we've been responsible for some of the critical manufacturing processes of our system, we've traditionally relied upon contract manufacturers for the bulk of our manufacturing process. So to support scalability, we plan to bring in a lot of this, bring in-house the manufacture of additional components with the goal of resulting in increased margins and improvement in yield and quality control as well. The larger footprint will also allow us to expand our manufacturing capacity as well, taking us well beyond the terms of the lease. And finally, just to wrap up, we're well funded. We have a pro forma balance following our recent capital placement and SPP of $96.5 million or 150 million Australian dollars, which will see us into early 2027. Thanks for your attention.
Welcome to this Nickel Industries presentation. Nickel Industries is the world's largest listed pure diversified nickel producer, producing a suite of diversified nickel producers. We've been a long-time participant in the Indonesian nickel market, where we've invested over $3 billion in debt and equity, and that makes us the largest foreign investment, surpassing even the ANZ Bank. We have a current market capitalization of $2 billion. We delivered adjusted EBITDA of $297 million in 2024, and at a current share price of 71 cents Australian, with a current EV/EBITDA multiple of 9.5 and a dividend yield of 6%. We think there's still a lot of value in the stock, particularly given that we have some near-term catalysts that are expected to take the business from that $297 million of EBITDA in 2024 to in excess of $1 billion in EBITDA on a consolidated basis in the next under 2 years. We have a very strong record of delivery, and we sit at the very bottom end of the cost curve. So that's what has allowed the business to maintain being a material dividend producer, deliver strong EBITDA despite a very weak nickel price environment. That said, any improvement in the nickel price, given our significant volume base, will deliver a cash windfall to the business. Mentioned we're a diversified mining company and processing company. We produce a number of products. So from the mining side, we produce low-grade limonite ore, which goes through high-pressure acid leaching plants to produce a mixed hydroxide precipitate, nickel and cobalt sulfate, and nickel cathode. And these are products that are consumed in the EV battery market, as well as aerospace and alloying industries. Our higher grade saprolite ore from our mine goes through rotary kiln electric furnacing facilities, which converts that ore into nickel pig iron, and that nickel pig iron is used in stainless steel. So that's really the key to our business, is that we're integrated across the mining and processing chain, and we produce a diversified suite of nickel products, each with their own supply-demand fundamentals and pricing and margins. If you look at the history of our operations, we've delivered very strong EBITDA despite a challenging nickel price environment. So if you look back at 2021 in the top left there, our adjusted EBITDA was $243 million. It grew to $339 million in 2022, $407 million in 2023, and $297 million in 2024. That's despite a weakening nickel price. And you can see back in December 22, we had a nickel price that it's close to 30,000. Today we're sitting at around 15 to 16,000. How we've been able to achieve that is volume growth. And if you look at our processed nickel in 2021, that was 40,000 tonnes. In 2024, that's 136,000 tonnes. Our mine ore sales have grown from 2.3 million tonnes in 2021 to 9 million tonnes in 2024. Throughout that whole period, we've been a consistent dividend payer. You can see there it's been 4 cents per share, except for 23, where it was 4.5 cents. The positive and the good news is that volume growth is set to continue, both in the processed nickel and in the mined ore sales. And I'll talk about what that growth looks like and where it's coming from. We have 3 key catalysts that are imminent to the business, and these catalysts are fully funded and will deliver a significant increase in our current EBITDA. First of those is increasing our mine ore sales from 9 million tonnes to 19 million tonnes. That additional 10 million tonnes at a $10 margin, which is the margin that we made last year, will deliver an additional $100 million in EBITDA. As I said, requires no capex. We have what's called our ENC HPAL commissioning in the second half of this year. This is the first HPAL globally to produce 3 of the key Class 1 nickel products. That is MHP, nickel and cobalt sulfate and nickel cathode. It has a nameplate capacity of 72,000 tonnes of nickel, and using a $7,000 a tonne margin, which is the same margin that an HPAL called HNC that we have a 10% interest in delivered last year. That's an additional $500 million in EBITDA. And again, that project is fully funded and commissioning in the second half of this year. And then finally, we have a new mine acquisition, the Sampala mine. The target there is around the end of the first half to deliver first ore from the Sampala mine. Our target there is to produce at the same rate as our Hengjaya mines, so 19 million tonnes, again at a $10 a tonne margin, is an additional 19 million, is an additional 190 million in EBITDA. All of this growth is fully funded, and all the numbers that I've just run through then, that assumes current margins. So all of this growth is not predicated on margins growing to where they aren't today. It's purely on current margins. And so back to the earlier comment, any increase in the nickel price will be a significant beneficiary of that. We are the beneficiary of a unique set of guarantees from Tsingshan, who is our partner and largest shareholder. If you look at every project that we've done historically, which you see listed on the left-hand side there, those projects have come with a CapEx guarantee, so we take no risk on any CapEx blowouts, a nameplate guarantee and a timeframe guarantee of no longer than 2 years. If you look at every project, it's been delivered ahead of that 24-month timeframe guarantee, in some instances as much as 8 months. And then if you look at the performance, all have operated well above nameplate capacity and at the HNC HPAL up to 40% over nameplate capacity. So very strong track record of delivery and execution. With this significant growth that's coming online, we feel that we're yet to see that factored into our share price, particularly if you look at an EV to EBITDA multiple. If you take that growth that I've just talked about, our forward EV EBITDA multiple is around 1.7. So we don't think that that CAGR growth is factored in. And if you look, we are one of the highest growth multiple companies in and amongst the ASX 200 world. So as I said earlier, we don't think that significant increase in EBITDA and nickel units is yet priced into our share price. So we think it's an excellent investment opportunity. As I said, 3 near-term significant catalysts that will take the business from that sort of 300 million EBITDA to in excess of $1 billion EBITDA. And any small improvement in the nickel price goes immediately to our bottom line. And that ends the presentation. Thank you for your time.
Hello, I'm Kevin Moriarty, and I'm the Executive Chairman of 1414 Degrees. We're on a mission to electrify industrial heat, but it's not a mission without revenue. It's a mission which has quite extraordinary revenue potential, and that is what I want to outline in this brief presentation. There's an unstoppable expansion of renewables, not just in Australia, not just in South Australia or Victoria, but throughout the globe. This is driven by the ever lower cost of solar generation, and that has opened up the prospect for electricity to be cheaper than natural gas burning about 90% of the time in a grid with an advanced amount of renewables. This then opens up the opportunity to electrify industries that are currently burning gas and want to either decarbonize or, in fact, reduce their costs by using electricity. We've been developing technology which can do this, and it opens up 2 major markets for us with very, very big upside because it involves a very large percentage of the world's energy. I just want to outline what our basic technology, the CyBox thermal energy storage system, does. It stores electricity, which can come directly from renewables or via the electricity grid. It stores it in the form of very hot bricks, which use silicon as their primary energy storage element. And we can recover that as hot air and then use it to generate steam in a boiler, or it can even directly drive a turbine. So the advantage of the CyBox system is that its charging and discharging are independent. This means that it can respond to price signals and availability of electricity in the grids or when the sun is shining, but it can be providing that energy to industrial processes as they need it, whether it's 24/7 or it is in batches. Cypher takes natural gas, converts it to hydrogen in much the same form as the gas that used to be burnt before natural gas was introduced to pipelines. The original gas supply from when I was young and many others was primarily hydrogen. We want to go back to the future and convert the methane to hydrogen and remove the carbon, which can be used therefore in other industrial processes such as pharmaceutical manufacturing. Our company is developing a major project on the Australian national electricity market. It's located just north of Port Augusta in South Australia. To the south are the interconnectors to the grid throughout the east coast, and to the north are BHP mines, of which there are currently 3, and BHP want to add a 4th. And while they expand their copper production somewhat threefold. To do this, they need a lot of energy, and particularly they want renewable energy. We're developing this project with a large battery, grid-scale battery, and the site has development approval for hundreds of megawatts of generation from solar. We entered into a term sheet with BHP, which will see a commercial agreement later in 2025, and that should lead to the development of that project, supplying electricity to the national grid and to the BHP mines in the north. Summing all this up, our team have developed technology which can solve real problems. It can provide affordable, decarbonised industrial heat. More important for shareholders, it can monetize grid volatility and stabilisation. And it can provide low-cost hydrogen for existing pipelines. To do this, we are developing multiple revenue streams. In the first case, we are offering industry heat as a service contracts. We'll be providing and selling grid services, frequency control, arbitrage, and controllable loads. And in the future, hydrogen sales into a very large global market. Our technology is ready to scale. CyBox has been proven with 8,000 operational hours to date. It's getting ready to be placed into the first industry sites. The Aurora Energy project is strategically located and ready to produce large amounts of renewable energy, both for our heat as a service contracts with industries and to BHP and earning revenue in the national electricity market. Our partner network is very strong, as you will have seen from this presentation. We're doing it now because the global shift has created a huge amount of solar and wind generation, and this is growing. Industry says it wants to decarbonise, but it needs to do it without added cost. This is what we are offering industry. So we have a proven technology, clear revenue pathways, and a strong competitive advantage. Thank you.
Hi, my name's Sam Spring. I'm President CEO of Conor Copper. Conor is an active explorer focused on the central west of New South Wales. We're looking to do multiple deals. We've done 6 deals to date that have unlocked 110 million of potential partner funding. We've seen 5.5 million of exploration to date. We're looking at doing deals for our more flagship projects. And only in the last week, we've also announced a very significant capital raising for the company. So it's a great opportunity to have the opportunity to walk through the story briefly. As this slide deck shows, deals and drilling. This is our core yard recently with some potential asset level partners as part of their review, looking at a further transaction that may take place in the near term. The usual forward-looking statements, I'll leave those to read at your leisure. This presentation will be up on our website. So who is Conor? We've got an industry-leading team. That's obviously critical for any business, but particularly in the exploration stage that we're at. We're targeting tier 1 copper gold discoveries, the sort of assets that would sit well in any major gold, copper, diversified majors portfolio. As touched on, we've adopted a project generator funding model for our large-scale porphyry projects. What does that mean in reality? It means looking to get third-party in at the asset level for them to provide funding, look at providing technical endorsements for the nature of the concepts that we're looking to test and providing the capital to realise those. As mentioned, we've done 6 deals so far that have unlocked potentially 110 million of asset level partner funding. And we're seeing that resulting in deals and drilling ramping up with management fees. Management fees is a key element to this business model. We're currently receiving a 10% management fee for 2 of our earnings. That provides us a source of income. That means that every dollar that we have at the equity level goes further, and we're on track, we feel, to achieve a self-funding business model. So drilling recommenced in the 4th quarter last year. We've seen 11,000 metres of partner-funded drilling to date, 5.5 million of expenditure so far. And as touched on, further deals to come. Our flagship assets are retained 100%, and we're in advanced conversations with a number of groups regarding those. So the team, obviously critical, but the faces here that you can see on the board and in the technical committee are also very significant shareholders. About 40% of the company is represented by the board, on the board. The technical team has an excellent track record of operations, but at this point of where the business is at, most importantly, they've got a clear track record of making discoveries on a global perspective, but also in New South Wales. John Holliday, our technical director, is probably the foremost expert in North New South Wales porphyries. He was a key figure in the origination of the Cadia deposit and the discovery phases of that led to that being Australia's largest porphyry project. He's backed up on the technical committee with Peter Lehman, our VP of Exploration, who's been involved with multiple international discoveries, including the Tier 1 Reko Diq discovery in Pakistan. So very strong technical team, very aligned with shareholders and asset level partners by being investors, being big investors ourselves. So the asset portfolio, focused on Central West New South Wales on the left-hand side here. We've also got a legacy project in Mongolia where we've got attractive asset level and equity exposure and an ASX listed explorer. They're looking to undertake drilling at 2 very large new discovery opportunities in the next quarter. But in Central West New South Wales, we've done a number of deals. We've got a big project portfolio. Within the northern part of the belt, the Northern Junee Narromine Belt, we've done 2 asset level deals with Anglo Gold Ashanti, the world's 4th biggest gold miner by production. That's potentially $100 million worth of expenditure before Conor shareholders have to look at funding that at the equity level or at the asset level. At the moment, we're receiving a 10% management fee from being the operator of that program, which again provides an income stream to offset corporate costs. We've also got asset level partnerships with a number of new generation tech explorers. Fleet Space for our Northern Molong project. Fleet in December raised $150 million. They're a very well credentialed explorer, and what we've got is a very innovative transaction structure we're looking to do maiden exploration at the Wangarden project in the second half of this year. At our Molong Belt project, our Condumble license, we've got Earth AI, another new generation explorer AI model, raised $20 million US in January this year. They've undertaken 5 holes to date at our Condumble project, just recently done an airborne geophysical survey. With Fleet and with Earth, we're getting exposure to new generation exploration, and these projects give our shareholders material exposure to success. And with the Earth AI model, it's a success-based model where they fund the exploration. Only upon making a new discovery do they earn an NSR, a net smelter royalty, and we retain 100% interest in the project itself. This financing that we've just announced in the last week supports Kincora funding drilling on our 100% basis at our one non-porphyry project in our portfolio, our Condobolin asset, which sits in the southern part of the Cobar Super Basin, which is seeing significant corporate activity at the moment, with the CSA mine being bid for $1.6 billion by Harmony at the moment. The Condobolin project is a historical mining field. It hasn't had modern systematic exploration. It's within trucking distance to an existing mill seeking third-party ore. How you add value as a junior is significantly enhanced given the nature of that project, the historical high grade near surface, and a potential commercialisation route within trucking distance. In Mongolia, our partner, as mentioned, is looking to undertake drilling. We retain a material interest at the asset level. We're their largest shareholder at the equity level. Again, that provides our shareholders significant exposure, albeit we're not the operator of that asset. Within these projects that you can see with red oval outlines, these are our more flagship projects. These are the ones that we've retained 100% ownership, and we're now seeking third-party investors for a strong pipeline where we'd expect further deal flows to be a question of when, not if, and a number of quite advanced conversations there. These are the sort of projects that really would sit well in any major mining company's portfolio, being in brownfield settings next to world-class existing mines, with a number of attributes supporting them being extensions or potentially new discoveries relating to those existing world-class mineral systems. So a pipeline of news flow here really being driven by increasing drilling on a 100% and partner basis, increasing deal flow, increasing management fees, all of those providing multiple shots on goal for what we're in the game for, which is discoveries, and discoveries are the greatest value driver in the resource sector. So a corporate snapshot, this financing that we've just announced really puts the company in a very strong position. Over the course of the last 12 months, we've been delivering on our strategy with a number of new asset level deals. A lot of that news flow has been a liquidity event for a former largest shareholder to exit the stock. That only occurred in midway through May last year. So we've got a clean shareholder registry, and really what we'd like to think with this financing being led by a number of really leading North American investors, including Rick Rule, Jeff Phillips, who's helping quarterback our North American strategy. It really provides endorsement of this business model and the valuation that we feel that we have. And with this financing, we should be on track to achieve our self-funding business model, see really extensive drilling being done. And the third leg to, I guess, our multi-leg stool is further deal flow, further material upside from our flagship projects. So the foundations are in place. We've got a really attractive outlook for copper and gold. We've got the majors revisiting growth, and we're trying to fit that part of the market by effectively providing a credible team with large-scale assets that can fit their profile of outsourcing exploration. So really favourable structural setting and tailwind given the commodity mix and where the sector's at. We've got an industry-leading technical team that's got a discovery and operating track record that's second to none for a junior in this part of the world, that are significant shareholders and aligned with asset level partners as well as investors at the equity level. We've got projects that have a significant pipeline of tier one scale potential in mining and exploration hotspots. We've got a funding model that's scalable, significant technical endorsement for that model coming in from this financing, non-dilutive asset level funding. The ratio of third-party asset level expenditure to our market cap is really attractive. And I think, again, this financing that we've recently done provides endorsement to that. Really importantly, catalysts, more deals, more drilling, more management fees and more discoveries. That's what we're in the industry for. And it's a really exciting junction, given where we're at with these value catalysts, to be able to introduce the story. If you've got any questions, my contact details are there, email address, mobile, as they are in any press release. Please be in contact if you've got any questions. But a very exciting company time for the company and Kincora Copper shareholders. So thank you again for the opportunity.
Thank you for the opportunity to speak today. My name's David Breeze. I'm the Managing Director of BPH Energy. I'm going to speak about our investee companies, Advent Energy, Clean Hydrogen Technologies, and Cortical Dynamics Limited. My primary focus will be on Advent Energy Limited. Australia is in the midst of a gas supply and energy crisis, with significant increase in costs to both domestic and manufacturing sectors. In the ACCC Gas Inquiry Report released in June 25, there was a shortfall potentially in the near term, the next 2 years, but certainly out by 2027 through to 37, there is a real risk of a 200 petajoule per annum shortfall. I'll give you context for that. That's around twice the amount of gas that is used in New South Wales by all domestic and manufacturing parties. So you really do need to get, as the ACCC has said, new sources of supply, and they need to be brought to the market in a timely manner. And in the absence of new sources, you're going to have structural shortfalls, and they consider it critical to gas market efficiency and long-term energy security that underlying impediments to the development of domestic supply are addressed. I'm going to give you further context to that. The Chief Executive of AEMO has most recently warned of blackout risks and as a result of the energy supply issues that we are facing in the east coast of Australia in particular. And what he said was that households and businesses could face a full day without power in the event of a major system-wide blackout because investments in grid stabilising technologies is not keeping pace with the closure of coal-fired power plants. And what you have is an increasing penetration of renewable, and that's increasing the risk that we won't be able to restart the grid after a Spain and Portugal-like blackout issue. So we need new sources of supply and we need new technologies, and that includes gas-fired power. Again, further to highlight this issue, in 2016, there were just 6 manual interventions to maintain a secure grid. By 2020, that had reached 321 manual interventions by AEMO as the energy market operator. And in 2024, that had grown to 1,800, almost 5 every day. In other words, with 4 million solar installations in rooftops across Australia and the addition of 21 gigawatts of generation, you have, with a peak demand of 36 gigawatts, the capacity for significant interruptions and issues, and that's what's causing these interventions that are occurring. You saw, in fact, in 2022, that AEMO had to seize control of the entire East Coast energy system to maintain stability and prevent blackouts right across the system. So AEMO have said yet again, gas alongside batteries and pumped hydro will enable a higher renewable contribution and support reliability as coal-fired power stations retire. And gas-fired power stations are going to play an active role in that system security. So when we look at what Energy Quest had to say in 2024, they said we've got to develop a plan B to head off a looming gas shortfall because the hope that the market will be able to bolster supplies is not working. And they referenced the structural deficit forecast out in 2028 through to 2037, and stated at that time that shortfalls of gas will heighten the threat of unreliable electricity supplies, while heavy industries that rely on the fuel source and cannot switch to renewable sources could be shuttered. I'll give you context to that. In the last 2 months, what we have seen is the smelting and refinery base metals processes in Queensland, New South Wales, Tasmania, Victoria and South Australia all indicate that they may have to close down unless they're able to change their operating characteristics. And of course, we have the manufacturers of aluminium, nickel, manganese, lithium and copper are critical for Australia's renewable energy future. And we've now got smelters at breaking point and seeking multi-billion-dollar subsidies in order to maintain their operations. Again, in context, in Victoria, you've had Sorbent, Sealy, Oceana Glass and Qenos shut their operations as a result of either gas shortfalls or energy costs. In New South Wales and in Queensland, you've had closures of Incitec Pivot, which is fertiliser, Qenos again in New South Wales, Molycop in New South Wales, Opal in Victoria, and Indorama in Victoria. Indorama in New South Wales. And so you're actually seeing thousands of jobs lost across Australia as a result of both gas shortage, gas price and energy prices. Why is that relevant to our Advent Energy? We have a project offshore Sydney. It's a proven hydrocarbon basin with excellent potential for further discovery of natural gas and a significant multi-TCF natural gas prospective resources. In fact, it has a prospective resource of 5.7 TCF in structural targets. I'll put that in context. The Bass Strait offshore Victoria has produced around 8 TCF of gas over the last 60 years and supplied 40% of the East Coast network demand requirements in gas. And that's in the middle of a 50% reduction in output, and that's going to occur within the next few years. So we have a current application to the Federal Court to enable us to be able to proceed with the drilling of the Baleen prospect. And we're 26 kilometres from the coastal pipeline network at just south of Newcastle. In New South Wales, you have 300,000 jobs rely on gas supply, and it supplies around 1.3 million households and 33,000 businesses, with the manufacturing sector, which is about 84% of the state's industrial gas loads, adds 33 billion in industry value. And as the New South Wales Business Chamber said, without addressing New South Wales' looming gas shortfall. These could be at risk. And New South Wales now supplies no gas from any sources at all. In addition to that, this project that we have in Advent could in fact become a carbon storage area as well. I'll give you reasons again why this basin is so important. The bulk of the supply now is going to come from Queensland, but during the winter months and sometime at different times, the pipeline there from Queensland down to the southern states runs at 108% or thereabouts of its design capacity. In other words, it can't in peak times take any more gas, and that's why the importance of PEP 11 and the other project that is in central and northern New South Wales, the Santos project, is so relevant to the future of gas supply in New South Wales and the southern states. So I'm going to now just give you a couple of highlights of the basin. Independent reports done by Geoscience Australia, is the federal government's resource body, and the New South Wales government resource department has also said that the basin, that is the Sydney Basin where our project PEP 11 is, contains an active petroleum system. It's considered gas prone. It has all of the essential geological elements of source, reservoir and seal, and reservoirs with sufficient porosity, permeability and volume for potential gas production exist. So important independent verification of the gas prone nature of the PEP 11 area. And that was also shown in the studies by Ampilex, which said that all of the late Permian coal measures being in the gas model is the way in which they looked at that process. If you look at the North Sea, you'll see that in fact, whilst the Le Mans sandstone areas were discovered in 1966, and they have an 11 TCF prospective recoverable map by 2010, they sit at a similar age in terms of geology with a similar porosity and permeability, and have produced quite consistently over the last decade or more. I'll move now just to wrap up and talk about clean hydrogen technologies and cortical dynamics. Clean hydrogen is a method to produce from natural gas, so therefore it's called a turquoise production methodology. From $2 worth of natural gas, we make both hydrogen and carbon nanotubes worth $175. So the reason for that is that we have a process that doesn't burn natural gas. We split it into the hydrogen and carbon nanotubes. CO2 is not emitted in that process, and instead the carbon is turned into a valuable carbon nanotubes, and they have increased wear properties, as well as significant electrical conductivity and other industrial properties that make it a valuable byproduct, in fact, a much more valuable byproduct than the hydrogen. One more slide and I'll conclude. Cortical dynamics, we have, through BPH Energy, around a 17% interest. It is medical technology designed to assist the anaesthetist during the anaesthetic process to keep the patient optimally anaesthetized. It monitors the EEG of the brain during the operation, and it's designed to help avoid or mitigate negative intraoperative and postoperative impacts from under or overdosing. In addition, we've developed an AI-based healthcare platform named Cordian, which uses a predictive algorithm for healthcare system and hospital usage. And that, for instance, can be used to predict ICU length of stay and neurological deterioration. So we have within our suite of investments different areas that can produce significant value accretion to the shareholders of BPH Energy. Thank you for your time.
Hi, my name is Vincent Algar. I'm the CEO of Tenant Minerals. We are operating a copper and gold project in the Barkly region of the Tennant Creek, near Tennant Creek in the Northern Territory of Australia. Cautionary statements. The company's been around for a few years. It listed with this asset as its base. We'll talk a little bit about the Bluebird assets and the Barkly assets. Share price currently around 0.6%. We've recently raised just over $500,000 in a small sophisticated placement. So we're sitting with over $1 million in cash and an enterprise value of about $4 million. Given the asset at Bluebird, this is a real opportunity for new investors. In terms of the company strategy, we're working on copper and gold, two things that occur together in the ore bodies in the Tennant Creek area. Copper is obviously essential for civilization and global energy transition applications. New copper discoveries like Bluebird are very rare, particularly in small high-grade bodies such as we see in the Tennant Creek area, which are very high value. When coupled with gold, the recoverable gold and recoverable copper, these make for very attractive ore bodies when economics are applied later down the track in calculations and other studies. Gold prices are very high at the moment, and that seems to be holding steady with the state of the world. And the copper price is holding its own at around $10,000 a ton. So where are we? You can see from the inset map, we're in a world-class location, central Barkly region, which is halfway between Alice Springs and Darwin in the Northern Territory. The region covered in green on the screen is a well-known and very well advanced mining area, which was mined for about 30 to 40 years and developed some major companies. The ore bodies in the area are known as Tennant Creek style IOCGs, iron oxide copper gold deposits, and they occur as either copper gold together in chalcopyrite ores or as gold only ores. Now, we've had multi-million ounce deposits in this area, Warrego, Nobles Knob, Pico, or copper and gold deposits that have covered the area and been extremely productive over many years. Bluebird, which is in the tenement block on the right-hand side of the screen, the red squares. Bluebird is a new discovery by Tenant Minerals, which was a greenfields discovery, the one, I think the first in over a decade in that area, which showed extremely high potential to be another Tennant Creek style production ore body. We look forward to being able to develop our studies on this project and show that to be the case as we move forward. Bluebird itself is an iron oxide copper gold deposit hosted in an ironstone. It's folded, and we've had some significant hits. You can see on the screen 63 meters at 2 and 30 meters at 6% copper and 6 grams of gold. So this ore body is able to deliver significant widths and grades as we work through it. We've been developing drilling through the ore body over the last 3 or 4 years, and we are reaching a point where we can define the first mineral resource. Mineralization occurs within those ironstone bodies, which is typical of the region. There's a lot of iron oxide mineralization here, which in our case is mainly hematite, and that allows us to liberate the material relatively easily. The mineralization, copper and gold mineralization, occurs mainly in chalcopyrite throughout. Over the last few years, the company's been building up a significant series of gold intersections, as visible on the screen, and we've been able to define the geology quite clearly by virtue of the lode style, these multiple colored lodes you can see on the screen, each one defined quite discreetly, but part of a much larger package of overall mineralization, which trends to the south and to the west and down dip and down plunge. So drilling here, while we've done a couple of programs this year, we've started to close off some of the areas. Unfortunately, didn't have all the results we wanted to get, but what we can see is that a number of regions remain open, and the arrows on the screen show where the mineralization remains open for growth. Importantly, the mineralization is quite intense when it starts, about 40 or 50 meters below surface, and then it starts to get really intense for a significant period, putting us in a view that there might be an open pittable opportunity here for the copper and the gold. We've done successful metallurgical test work showing that with relatively straightforward processing, we can recover a economic style concentrate, commercial concentrate, which is around 24 to 29% copper and 1.5 to 4 grams of gold, which is a very saleable product and gives us comfort to move forward with our study work. So one of the things we've been doing this last year is generating new targets outside of Bluebird with the purpose of finding a second Bluebird in the area or other gold deposits. What we can see from this map is we've targeted two in particular, an area called Bluebird East, and our recent announcements outline what we found there. And then more recently, we put out an announcement on a project called Babbler, which is a large-scale gold opportunity down in the south. It's quite a different target. It's in slightly different rocks, but we believe it's a precursor and a marker or a targeted area for us to work in for looking at some fairly widespread gold mineralization drilled in the 1970s. The Bluebird East anomaly, why do we like it? It looks a lot like Bluebird looked above the weathering profile. So you can see on the diagram, there's a little dotted line in the base of weathering. That base of weathering has this very similar signature between the surface and the base of weathering over Bluebird, but there are no holes below that target over Bluebird East. Having reviewed the historical drilling over that area, not only is it widespread, but it is very, very cohesive. It produces an anomaly of a similar size and scale. And it's quite coherent over the top of a lode. And you can see from the diagram on the right where we've modeled those two lodes. We think there may be a relationship between Bluebird and Bluebird East, and we look forward to going and putting some holes below that line and with the opportunity to find another Bluebird underneath. We think that opportunity for Bluebird-like anomalies exists in a number of places along strike here. Most recently, we've outlined the historical work done at a prospect we're calling Babbler, which is to the south of Bluebird by about 7 kilometers. In the 1970s, some 7 drill holes were drilled into this prospect. 6 drill holes were built into this prospect, and they encountered some very interesting mineralization, gold mineralization in the region of 10 to 20 meters of mineralization at about half a gram, with some areas running over a gram and some quite significant areas of copper. So we had 39 meters. We had copper mineralization over quite significant widths with 72 meters, 56 meters at 251 ppm copper, which is significantly above background copper, with some grades up to 0.12% copper. So we're very excited about what the Babbler prospect is telling us. It's in the rocks immediately above the more regular finds in the Tennant Creek area. But we believe there's a body of technical work that supports further exploration in this area, which we'll be following up with geophysics and then some shallow drilling. Of course, the company, for those who are following us, understand we're in a strategic alliance with CUFE Limited and Emerson Resources. to develop our resource base and then evaluate a multi-processing facility for copper and gold and other critical minerals in the area. With a lot of activity in the area, we've continued to progress through our scoping study work as a group, and we're getting close to releasing that scoping study for each of the companies. From there, pending a positive outcome, we'll move quickly into a pre-feasibility study. The point of the strategic alliance and the collaboration objectives are about determining a resource base, developing a mining schedule, confirming a processing pathway for the shared concentrates, and then finding a location for that, and then developing a cost estimate and looking at operating structures by which we can share put our shared resources together and reopen a facility in this spectacular mining area. So what is our timeline? Our timeline of activity over the coming months, obviously working on that initial mineral resource estimation for Bluebird, and then getting scoping study result out for our part of the Copper Alliance with CUFV and Emerson Limited. From there, we'll begin environmental baseline studies and heritage agreement work on licensing to move the project forward from there. In addition, first pass drilling at Bluebird, first pass drilling at Babbler, and then extension drilling at Bluebird as required to enlarge that resource. We believe there's a lot of opportunity still there. Feasibility studies and permitting for the Alliance will continue along the way. So all in all, we believe that Tenant Minerals offers a ideal exposure to copper and gold in a growing area of the rejuvenation of the Tennant Creek mineral field.
Hello, my name is Dimitri Cortelis. I'm the Group CFO here at Sunrise, and I'd like to take you through a snapshot of our FY25 annual results that we released to the market a couple of weeks ago. In terms of our group structure, we have an A and a B class shareholding structure. The B class are listed on the ASX, and the A class are represented by our growers, which is a non-listed share. So the company is essentially owned by our B class investors, which have 100% rights to dividends and certain voting rights as well. More details on this can be found on our website. In terms of a brief thumbnail sketch of the Sunrise story, we are 75 years old this year, going back to our roots as a cooperative back in 1950, and progressively have launched and created brands, acquired milling operations, acquired ancillary and supporting business units over the years to the group that we are today, which is a over $1.8 billion top line revenue business. And in the year, we just delivered 147 million of EBITDA, which I'll talk to shortly. From a geographical perspective, as you can see here, we really do have markets across the world. We operate and sell products into a multitude of countries. We have over 50 countries that our products are located in and listed in various retails and wholesale stores. Over 60% of our revenue is generated outside of Australia. And of the total group revenue, 70% is in branded sales. So the step change shift in terms of how the group has evolved over the last few decades is essentially moving away from a pure agri-focused bulk trader of rice into a global FMCG player, branded player that has branded products in all of the markets that we operate in. We have over 1,500 products across our product suite, and that comprises over 45 major brands and with operations in over 10 countries around the world. In terms of the update of our annual results for FY25, we had flat revenue coming in at $1.85 billion, and I'll talk to the drivers of that. But pleasingly, our EBITDA up 3% to 147.7 million, and that flowing through to NPAT, where we delivered a $70.7 million number. That equated to a basic EPS of 102.9 cents, which was up 6% on the prior year, and our largest ever dividend declared for the year of 65 cents, which comprised a 15-cent dividend that we declared at our half year, which we went to the market in December, and another 50 cents in our full year in June, taking the total dividend for the year to 0.65. So a very healthy dividend yield on that number. And you'll see shortly we have progressively and continually paid consistently and strong dividends to our shareholders over the years. In terms of the activity for FY25, on the positives, we had some significant brand strength coming through, which bolstered our sales. We did grow volume in a number of our key markets, the Middle East being one of them, also supported by new product launches, and we had a very successful Ramadan campaign earlier this calendar year. In the US, with increased exports rather, due to ample supply in the Northern Hemisphere, we have a milling operation in California, and that helped to support that supply chain. And then in Australia and the rest of our international markets, some strong performance in some of our key brands. Toscano was one of the core brands, which is essentially the artisanal pizza baking and bakery brand that we have with one of the most popular pizza bases in the country. The top line revenue was put under a little bit of pressure from a perspective of just weaker global tender prices that kept prices below long-term averages. And then, of course, the impact of cost of living pressures coming through in consumer spending. Despite that, we were able to deliver an EBITDA increase of 3% on the prior period. And as mentioned on the previous slide, delivering an NPAT increase in the 70.7 million mark. Sustainability. So it really is in the pillars of what we do here at Sunrise, cut across 4 key components of thriving people, thriving planet, thriving community, and inspiring products. We've had some significant step changes in the space. The rice growers in Australia are amongst the most efficient rice growers on the planet due to necessity from a water availability perspective. And we're actually utilizing that type of technology in the other growing regions that we grow rice. So there have been some significant step changes here in water usage in particular that has also helped shape our sustainability footprint and our sustainability strategy. We've also launched our net zero roadmap for 2030 and 2050, in addition to the science-based target initiatives that we submitted last year and are tracking against that on an annual basis. A quick segment snapshot in terms of the various divisions in Sunrise. So the Australian rice pool business was put under a little bit of pressure from a poor milling yield. This is the amount that gets paid to the Australian growers, and we came in at $406 per tonne, which was down on the prior year. That doesn't materially impact the profit businesses, which you see on the right side of the group, of the page. All the businesses that are reflected here on the right are, as I mentioned, owned by the B-class investor, and the company essentially delivers that profit with the entitlement to dividends entirely for the B-class investor. So going through the profit businesses, our international segment, which is our largest division, delivered a revenue of 860.4 million, slightly down on prior period for reasons that I mentioned previously, with global tender pricing being one of the main drivers in that space. Despite that, though, we were able to deliver a very solid EBITDA of 56.7 million, which was in line with last year. And the rice food segment, which is a lot of innovation has gone into the space. We have a very broad pipeline of products, from rice chips to rice cakes to protein and other types of rice snacking, innovative products in that product suite. Quite healthy from an accretive perspective in our EBITDA margin, and our EBITDA number coming in at 18.6 million, which was substantially up on the prior period. And you can see that revenue growth to 132.5 million as well. Riviana Foods, the next segment, is essentially our artisanal product offering of entertainment platters. And we have products like olives from Greece. We have pesto from other parts of, or we actually manufacture that locally in Australia. We have pizza bases that we import out of Italy, croissants that we import out of France and Belgium. So your European-style artisanal product suite, about 80% of the products in Riviana Foods are imported. So the segment has been exposed to the FX volatility as well as the supply chain disruption and shipping costs that we hope to start stabilizing at the moment going into the next 12 to 18 months. FX continues to remain the significant pain point because we purchase most of those products in US dollars as well as the euro. And as the Aussie has depreciated, it's put a little bit of pressure in that segment. Moving on to CopRice, which is our animal nutrition division. We've had a very solid year in CopRice with whilst revenue remaining pretty much flat compared to last year, the product mix and the accretive product suite that we brought into the animal nutrition segment with the recent acquisition of SaverLife and a few years ago with Pride's Easy Feeds in the equine space, we have delivered a material contribution to EBITDA. CopRice's EBITDA, 24 million, that's up 40% on the prior period, and really helping to step change that segment away from historically, which was a stock feed and ruminant type of animal feed business, into now more of a branded FMCG animal nutrition space. And then finally, the corporate segment, which owns all of the assets of the group and essentially charges a asset finance charge to the Australian rice pool. So you can almost treat that like an annuity style income. EBITDA coming in at 40.5 million. That was down on last year because we had asset sales last year that were non-repeating. So underlying numbers still coming through very solidly from a corporate segment perspective. Just a brief history of performance. You can see our revenue has grown over the last number of years. And despite what's happening in the Australian rice crop, we've demonstrated that we're able to build a resilient model of sourcing globally and creating a demand and supply profile of matching the types of rice that we need to supply into our international sources and continue to do that year in, year out. So regardless of what seasonality or drought is doing in Australia, over the years, we've built this resilient supply chain that we're able to meet the global demand of our markets. That has fled and filtered through into our EBITDA and NPAT numbers. So you can see that with the performance in the bottom left-hand chart. Top right, we have a consistent and strong dividend profile, and it has been the case for many years, both when we were listed on the NSX and more recently on the ASX. This is now our 6th year on the ASX, and we've continued to deliver strong performance for our shareholders, and most recently a 65% per share for the total year. And EPS again coming in at 102 cents. So we have outperformed the index when you compare this over the preceding years, 350% against the ASX 300 accumulation index of 110%. We have paid out $252 million worth of dividends to our B-class shareholders over the period in the charts. And we've also invested almost $400 million in growth. And that's a combination of M&A, which is around $135 million over the last 7 or 8 years, in addition to CapEx, both strategic and operational in nature, with our own internal hurdles to ensure that we are creating value and delivering against a WACC rate so that we're creating value for our shareholders. From an EBITDA and a cash flow perspective, you can see the profile growth compared to prior period, and rice food and CopRice really has been the standout segments to talk to, and that's where a lot of our innovation, product growth, and from a margin mix perspective, where we're looking to deliver more products going forward. So watch this space. We have an exciting pipeline of innovation that we're looking to launch to markets. Net debt consistent with prior period, coming in at $218 million. And again, ROCE 13.6% as we continue to create value for our shareholders. The gearing ratios and leverage, so gearing coming in at 26% and leverage at 1.5 times. That is entirely made up of seasonal debt. We don't have core debt. We've paid all of that down, and that's evident on this page. So our seasonal facilities are essentially back-to-back with inventory, which is our short-term, essentially marketable asset in markets over the coming 12-month period. So we've been able to go after some acquisitions that we essentially funded from our in-year operating cash flow and continue to have a very strong balance sheet and prime for future growth. We have just under $200 million of capacity in our core debt facilities that we're able to go after acquisitions should they fit into our strategic pillars. Just a quick recap on our strategy that we launched to market in December earlier to 2024. So the core focus in our 3 key markets, which is across ANZ, it's the Middle East markets, and it's the US markets. When you consider rice, it is the most calorific carbohydrate on the planet, and it's consumed by over a third of the world's population. So really launching products into this set with a staple product, staple diet, and couple that with innovation, particularly from a rice food perspective. When we talk about products like value add, particularly in the microwave segment, rice chips, rice cakes, and protein as well. We see some opportunities in the core markets that I've mentioned, where we're looking to launch these products and then also increase the breadth and the depth of our offerings in the markets that we are currently operating in. And progress against strategy. This is essentially year one of our 2030 strategy that we kicked off earlier this year. So over the next 6 years, looking to really deliver growth at the top line and the bottom line, where we have an aspirational target of growing the business to $3 billion at the sales level and get to double-digit EBITDA percentages. And how we would do that would be a combination of both organic growth and inorganic growth. And over the period, obviously, assess to make sure that is accretive in nature and contributing to the overall growth of the business. So a number of product lines that we've launched in a number of categories, strong progress in our sustainability strategy. We have developed a growing engagement and industry transition as we've given up the single desk. So we're no longer the single export license holder in Australia. And therefore, we're able to work a lot closer with our growers locally to essentially have more bilateral arrangements and contracts in place, so we can strategize and get them to grow the volume of rice that we actually need to address our utilization and efficiencies in the mill, so we can return a healthy paddy price, but then equally deliver into our international markets. And continuing through the piece with operational efficiencies and cost optimization. And again, a capital management strategy where we have a strong balance sheet and continue to look at opportunities as they see fit. From an outlook perspective, a number of items on the page to call out, but really the summary of we're looking to continue the momentum that we delivered in FY25 and take that into FY26 with growth at both the top line and the bottom line. We do have a number of headwinds that may impact that, the likes of intensified competition. We've got some currency challenges with the AUD and particularly against the US and the Euro, in addition to the Papua New Guinea kina, which is a very big market for us, and we sell a lot of rice into that market. And then, of course, the noise with global tariffs and trade impacts that may eventuate. But aside from all of that, we certainly expect to deliver another strong year, and we're working very hard to do so. Ahead of us, from a paddy price perspective, the C25 crop has been harvested, and that has resulted in a total received of 511,000 tonnes of paddy, raw paddy. So that will be more than sufficient to essentially deliver a operational footprint for the coming 12-month cycle, and therefore make sure we have a full milling program accordingly. We've held the paddy range for the Australian growers constant at $380 to $450 per tonne, and we'll update that as the year progresses. So thank you for the presentation today. Looking forward to questions and following opportunities to present to you again.